I appreciate everybody being here. It's nice to see everybody. It's our last food for thought of the year, so it's great to get to see everybody before the holidays. And of course, we hope you have a wonderful time over your holidays. And somebody was just telling me, make sure you don't overindulge. So I'll just remind everybody to keep it safe through the holidays. Today's topic, the markets, fixed income, and the Fed. I'm going to get into it. I have a lot of information. I actually am not sure how long this presentation will go, so I'll hopefully be able to get through everything that I put together. It's interesting. We want these to be very current, right? We want to send the invitations out in a timely enough manner where you can work your schedule around them. But we, of course, also don't want to send things out too early because the market moves so fast, the economy moves so fast. And we want to make sure that the topics are relevant. And then once you get into it, then you start to pore over data around a certain topic. And of course, then your mind starts racing, or mine does at least. Okay, maybe I should do this. Maybe I should change this. Some of you may have seen Robert and I in the green room there, still making changes to the slides. As you guys know, if you've ever come to a dinner event, we don't have slides, so the agenda is built by you. But here I have to spend time trying to figure that out. So we're going to talk about the markets. We're going to talk about the Fed. We're going to talk about fixed income. But also, recently I had a client, I think that's a good example of this, who came into the office for a review meeting, and I asked him how he was feeling about things. And he said he was feeling good, feeling good about us, and feeling good that the market had come back, and that he had seen some good returns over the past 12 months. But then he proceeded to say but he wasn't really optimistic about the markets moving forward. And so I asked him the question, bless you, why? Why do you say that? And he said, well, there's just so much going on. There's wars, there's interest rates are high, the election's coming up, the impending recession potentially, just all of these general topics. And so when we build these presentations, the proxy for the information is really Robert and I sit down and we talk with each other and with the other advisors and figure out what are we hearing from you, right? Because that's the best guide for us of what we should put information together around and what we should research and what we can try to help, bring some clarity to. Of course, also the media, right? Because we know that a lot of the things that you hear come from the media, and you guys who've been with us for long enough know that we'll go after the media quite a bit. I'll do some of that today, have some fun with that. But that's the other thing I'm going to cover is just some of these things that everybody keeps hearing that causes worry. Because the reality is we define success internally as a combination of two things. One is our execution, right? And every time you guys come in to meet, we benchmark, we try to help you understand the things that we do, the evidence that we follow, how is it actually translating or manifesting in your returns and in your experience, right? That's goal number one internally. But goal number two is, are we doing it in a way that helps you feel confident and comfortable? One, in the relationship with us, but two, that you're on track, right? That you can go spend and enjoy. I've had a few meetings recently with folks who seem to be finding ways to do that. My experience is savers don't do a great job of becoming spenders, but I have seen a little bit of it. I don't think they're here today, but we had a client who traveled 192 days this year. So pretty amazing. But yeah, we want to, which I have 3 kids, so traveling like 4 days seems like a lot. But so we also want to talk about all those things that are, that you're hearing, because we want to try to find ways to see if we can help you feel more comfortable about what the data shows and what the information is that's real versus, there's a show my kids like to watch called Mind Games. I don't know if you guys have seen this. It's pretty interesting. They break down all these different things. They had a booth with money in it, and there was a sign over it that said free money. And this guy was standing there, and when he was standing there, people would come up and they'd be like, what's the catch? And they'd kind of reach in and grab some money, and it was free. They could leave with the money. And then when he left, people would come up, and as fast as they could, they'd snatch the money and stick it and walk away, hoping that nobody was going to see him. And so it's just all these things. Well, we all, you've probably been introduced at some point to just the idea that negative information takes priority in our brain. I think it's the amygdala which prioritizes negative information, and that's been very helpful for the human race over time. But of course, it's very well understood by the media, which I think is why we tend to see so much information that causes us a little bit of anxiety. So with that being said, I just wanted to recognize today, some of you, when I said what day this was, the presentation was, you also remember that today's Pearl Harbor Day. So I just picked out a few stats. I don't think there's anybody in the room that was a part of Pearl Harbor Day now. And, those days are gone, but 2,403 Americans were lost, 1,100 were injured. We lost the USS Arizona, the Oklahoma, the Utah, the Bowfin, which is a submarine, and in 1994, Congress dedicated December 7th as National Pearl Harbor Day. So I had a client who sent me a really cool letter just reminding us about what Christmas is about and the spirit of giving. It was just a really cool story, and you know, it kind of goes along with this kind of stuff, just to maybe take a minute to remember why today is an important day. So 1913, the Fed was created, and it really has a dual mandate. Many of you are familiar with this, but just to recap, mandate number one is price stability. So this is really inflation. It's to keep inflation at approximately 2%. More important than actually having inflation at 2% is to make sure that it doesn't stay above 2% for a prolonged period of time. That's really what the mandate is from a price stability standpoint. And then their other mandate is sustainable maximum employment. And there really is no number. If you look down there, you'll see the definition has no explicit goal for unemployment. And the reason is because they want to have the fluidity to be able to evaluate different economic conditions to try to find what they think is the right level of unemployment. It's certainly not an endorsement on Greenspan, but many of you have heard me say this before. He's famous for being quoted as saying, if you understood what I said, I didn't do a good enough job of explaining myself. So it's also true that the Fed, you know, is particularly with the markets, and we always want to separate the economy and the markets, right, in our discussions, but the Fed has a challenge of not just making the right decisions, but also not tipping their hand too early, right? They can't show what they're going to do, otherwise the market will react in ways. And for those of you who've seen some charts, actually there's one in here today that's pretty good at that. You can see that market returns oftentimes have strong reflection of human behavior, particularly in the short run. And so that's one of the things the Fed is really working hard when they kind of mask their statements to make sure that they don't give too much away. Generally speaking, that target, though, is where they would love to be. They'd love to be about 4% unemployment and 2% inflation. Okay, and many of you may know, Robert and I started in a place of this business where we studied Austrian economics, which doesn't believe there should be a Federal Reserve, believes we should have all money backed by gold. And so none of my comments are illustrative of a point that we believe current monetary policy, the way it's, you know, it has transpired is the way we'd like it. Frankly, I'm not an economist, so I don't know that I'm qualified to identify an alternative, but it's the reality is this is what they're trying to do. Another thing that you've probably heard about, and particularly people, you know, I'll get emails throughout the year of like somebody who sends me a newsletter that they're reading, and usually they're not sending me a newsletter that's very positive. They're sending me something that's very negative, and they want to hear my thoughts about it. And there are a lot of doom and gloomers. As an old adage, if you stay negative for long enough, eventually you'll be right. And money supply is another thing that probably, you know, builds into the narrative quite a bit, right? Just the printing of money that's really started back in 2008. You know, this idea that we'll print our way out of all of our problems, and money supply is a major indicator of that. M1 money supply is current liquid assets, so currency in circulation and traveler's checks. I thought it was kind of funny that traveler's checks are listed. Does anybody use traveler's checks anymore? People must. I remember being a kid and going on a trip and having, you know, the fold full of the traveler's checks. But the second thing is a broader measure, which is the M1 plus savings accounts. What it's really trying to measure is how much money is in circulation to be spent, right? Because the essence of inflation is too many dollars chasing too few goods. It's really a supply and demand question. M3 is more illiquid. But when you hear kind of the doom and gloom around it, which by the way, you know, one of my questions around kind of the doom and gloom stuff that we read is, what do they offer as the solution? And my experience is they're either selling you something or they give you no solution. They just spend a bunch of time telling you how bad stuff is. So M2 is a big part of that. So this graph represents what M2 has looked like. So 1914, and then you can see out here, this major spike. There's a handful of takeaways from this. First is that there does appear, and I always want to be very clear about the difference between correlation and causation. It's a really important distinction. There does appear to be a correlation that when money supply gets, really high, that is going to be followed by high levels of inflation, which is represented by the blue. And of course, there's periods way down here of deflation where we have to be concerned about as well. But when we think about the graph, ultimately the context to take away that I think is important is more like what's going on right now. What's going on at the end of that graph? Why does it look that way? And why has that motivated the Fed to do what they've done? And the reality is that largely is 2020. We always want to make a distinction between monetary policy and federal policy, right? There's a big difference. 2020 was a great time to illustrate that, because when the Fed makes decisions to put money in, buy bonds, things like that, there's real assets involved. There's assets in the bond markets that mature, that fall off balance sheets. There's a mechanism there to make that work. But in 2020, there was fiscal stimulus. It wasn't monetary stimulus. It was just, hey, we're scared about COVID, so everybody go home, but you can't live if you don't have money. So we're just going to send, $2 trillion into the monetary base to be spent. And, again, no commentary on whether that was a good decision or not. But from a financial perspective, you see just the explosion in money supply. You can also see that what the Fed has done has significantly decreased monetary or money supply. And, it's going to be an interesting experiment, but it appears that Powell has done a pretty darn good job. Again, that's not me endorsing monetary policy as it sits today, but we have seen inflation come down quite a bit. It hasn't had incredibly negative impacts on the economy. Obviously, the increasing of interest rates is designed to slow the economy, right? It's designed to constrict money supply. It does that in a number of ways. The first is just by making lending more difficult. So the leverage that consumers have has changed significantly. It also incentivizes savings through higher savings rates. And of course, it has impacts on business because it increases the cost of capital, which creates situations where people lay people off, or companies lay people off. We just saw on Monday this week, Spotify's stock went through the roof because they announced they were laying off 17% of the workforce. And this is not new. This has happened everywhere, right? And even at my size, 2020, right, when we went through that circumstance, we were certainly not just keeping our heads in the sand. We were thinking about, are we going to have to lay people off? What are we going to have to do? What do we have to cut? All those things. Well, what happened really because of that explosion, and you could argue that they were behind the curve, right? Really these discussions started in 2008 that this printing is going to come to roost at some point, but the action was kind of unprecedented, right? You see right here, this is the pace of increases of interest rates relative to other times in modern history, right? And so you can see that the steepness of the increases is really more than we've ever seen, moving them incredibly fast, right? And part of the reason is because economic data lags, right? So what happens is the Fed increases interest rates and people want to see inflation come down the next day. But that's not going to happen. So then you have these pressures, right, of trying to, again, figure out how to communicate to people in a way that is helping but not, giving too much information away. So these progressive interest rate increases over time. Now I would say that the market kind of thinks we're done. Maybe one more left, but generally, and we always want to remember, the market is forward-looking, right? The economy looks back, the market looks forward. The market, I think, is expecting that if we're not done, we're pretty close to being done with interest rate increases. So this brings up all kinds of stuff, but from a practical standpoint, one of the things that it really brings up is the idea that, and I'm going to cover this a little bit here coming up, but we get the question, it's definitely in the media, of, man, I can get 5% in a CD. Why shouldn't I just take my money and put it in that? Or I can get 5% in short-term treasuries, 6%. Why wouldn't I do that? And the question that I ask, to kind of address that is, are you doing that because, and this again is kind of, as everything that I show, I'm going to try to kind of relate it to you as an investor, is Are you doing that because you want to get more conservative and you want to stay more conservative, right? It's 5% now, but we've already heard talks. One expert, came out on CNBC this week and said he expects 4 rate cuts next year, right? Now, I don't put a whole lot of stock into what experts say. I should use quotes when I use the word experts, but monetary policy has been extreme. If you look at this particular graph, you can see that after rate peaks, generally we see rates start to move back the other way, right? Because the rate peaks are designed to slow the economy, but if you slow the economy too far, what do you get? You get a recession, which is not ideal from a optics perspective for sure. The Fed doesn't want to have to admit they went too far and they pushed us into a recession. So getting back to this, what we looked at is if you're willing to go there and stay there, that's one thing. But if you go there and then interest rates come back down to 3% or 2%, are you then going to feel not unsatisfied and then want to get back into the market? Because what does that sound like? That's market timing. And you guys all know we don't believe in market timing. So what we looked at here was, okay, so interest rates peaked in 1981. They then peaked next in 1989. It was an 8-year duration. The S&P 500 earned 14.2 small caps as defined by the DFA small cap index returned 15%. So if you jumped out to get fixed income returns and then you were unsatisfied and you jumped back in, you missed 14 and 15% respectively in those 2 asset classes. And then again in 1989, 6-year duration, 12 and 12. I was kind of surprised when I saw that, identical returns in both asset classes. But right? Then you get back to the next one, 1995, 5 years in large companies, you would have missed a 28.6% return to get if you had got into fixed income and then got back in. So if that's in your brain, that's okay, as long as you're thinking about getting more conservative over the long term. But if it's in your brain because it's a short-term decision, you have a major risk of losing return. Now 2000, right, it worked the other way. Now, that being said, the interest rates in 2000, although they peaked, weren't super attractive, so nobody was rushing to the peak of 2%. But that was the one period where large companies. Now, you can see small companies, right, did quite well over that time frame. But the general kind of narrative exists that if you want to do it and stay there, fine. If you want to do that because you want to eventually jump back to something else, you're probably getting into the risk of market timing. I pulled a bunch of stuff, which is just kind of fun to go after the media a little bit. I tried to go across a bunch of different time frames, but this is a period where Goldman Sachs, JP Morgan, Barclays, Credit Suisse, Merrill Lynch, and Morgan Stanley all had predictions in 2011 about what the market was going to do. The S&P was 1250 when this article, or when these articles came out. Goldman Sachs had it at 1450, JP Morgan had it at 1400, Credit Suisse got it. Barry Knapp from Barclays had it at 1420, Merrill Lynch 1400, and Morgan Stanley was bonds. They didn't talk about the S&P. Treasuries on the same side. Current treasury yield is 2%. You can see they called it to be 4%. JP Morgan called it to be 4.25. So, obviously, I don't need to say the moral of the story, but these people don't get on TV and act like they have some question about what they're predicting. They get on TV and act like they know exactly what's going to happen, right? Everybody knows this guy. This is the Cramer effect. So Jim Cramer, in 2015, he called to buy Qorvo. 6 months later, it was down 37%. He called to get rid of Best Buy. 6 months later, it was up 124%. He called to buy Kohl's, and after 6 months later, it was down by 41%. Believe me, I could have done an entire presentation on this stuff. Right? When you Google it, it's not hard to find. More recently, 2022, JP Morgan and Jamie Dimon says that stocks could easily fall another 20%. This was October of 2022, and that we will have a recession within the next 6 to 9 months, which obviously that time has already passed. And then I just happened to stumble upon this. So up here, while we see no reason, this was last week, I think, maybe this week. Days go by fast. While we see no reason to curb our enthusiasm for stocks heading into December, stocks have gone too far, too fast during this rally, and analysts expect them to fall. On the same page, right? So I want to play a quick video. I'm hoping to have a screening of this in next year for one of our educational events. And I'm also hoping that I can figure out how to make this work the right way. I actually sent my investment team my FinFolio. I wasn't seeing, you guys know FinFolio, it's the tool that we give you guys to look at returns. I couldn't see all the fields, and I was in the meeting with a client and I couldn't get to the performance history, and I sent Nick, who's one of the amazing investment financial planners and CFAs on my committee that you guys haven't met probably, but he comes out every now and again with Steve, our chief investment officer, and I sent him a nasty text, FinFolio's down at the wrong time, you got to figure out how that fixed, and I sent him a screenshot and he said, zoom it out, and I zoomed out and there it was. So, you guys, most of you know we follow evidence from the University of Chicago. That's facilitated through a company called Dimensional Funds. This gentleman named Errol Morris, who directed The Thin Blue Line and a bunch of other movies, he just did a piece, and I'm hoping to get a screening for all of you sometime in next year. But this is the trailer that just came out.
You said I'd compare stock pickers to astrologers. But I don't want to badmouth astrologers.
Well, I mean,
if you listen to financial news every day, everything is chaotic.
my generation came along at the right time. Data was starting to be generated. Nobody had touched the data, so whatever you did was new. It was like shooting fish in a barrel.
It's very hard to beat the market. I said, why don't you create a portfolio which is low cost and will give you systematic exposure? I thought of it as a passive strategy. I was skeptical that investors would have the patience to want to do this.
Did you realize that you were challenging how investing was done?
Oh, absolutely. That was fun.
I loved it. We were armed with so much knowledge. We knew things that Wall Street didn't know.
What's the difference between a data freak and a data dog?
A freak thinks it's fun.
The smallest 20% of companies on the New York outperformed the S&P 500 index fund by quite a bit. But people weren't investing in the stocks of smaller companies. We're the first people to treat small cap stocks as a separate asset category.
It worked.
Are you surprised?
Of course not. Data doesn't lie.
The real world was challenged by that way of thinking, but it all made total sense.
Information tells you where you can make money and where risk is.
What investing is about is dealing with uncertainty. People want to shrink away from uncertainty. And it's uncertainty that really creates opportunity. Pulling your hair out and watching financial news all day long. Tune out the noise.
So that hopefully I'll have it's a full movie, and hopefully I'll have the ability to get a private screening for us sometime next year. Let me get back to this. Am I up there again? Okay. Now can I move? All right. All right. So that's a segue to data, right? So we want to talk about data. I mentioned the client that had come in and all the different things that they had mentioned were concerning to them. And so we just tried to pick a few of them. The first one we picked is stock market's overvalued. You're starting to see that again, right? These are just Google searches. Is the stock market overvalued? It looks overvalued. If you go up here on the far right, you can see that Morgan Stanley, this was in May of this year, was warning that the stock market was overvalued. And I want to be clear that looking at the valuations of stocks is not something that you should shy away from. Price earnings ratios, price book ratios, these are what we term valuations. These are really important. We look at them as an investment committee all the time. And but we have to be careful of what we see from them, right? We can see opportunity in valuations, and we can see a need to diversify through valuations, because if you look at what you're seeing up here, the Magnificent Seven are Apple, Tesla, Amazon, Meta, Microsoft, Apple, and NVIDIA. The price book ratio of those this year is 11.8%. This is the price book ratio, 3%. You don't have to know exactly what price book ratio is. You can just kind of identify the relativity of the numbers. Over 30 years, the average price book of the U.S. market is 3. Right now, the NASDAQ is 5, S&P is 3.8, et cetera, et cetera. So there would be no way to go into this year and not feel that by virtue of using valuations as a benchmark, that these stocks are overvalued, right? From a price book ratio standpoint, they're incredibly overvalued. If you look here at the return of the U.S. market as of July of this year, the U.S. markets were up 20%, global markets were up 13.9%. If you remove the 7 from the U.S. market, the return was 10.8. So if you had made a decision based on valuations that these companies were overvalued and decreased or eliminated exposure to these companies, you would have lost half of the return of the S&P 500 year to date as of July. Again, it's not that this is, the consistent theme you will see here is this is not me saying you shouldn't consider these things. This is me getting back to correlation versus causation. Is there correlation to returns and valuations? Yes. Should it cause you to run from things with high valuations and or predict that the market is overpriced because of those valuations, like all these media people do? The data just doesn't suggest that that's a good idea. Which brings me to 2 things we are constantly addressing, which is 1, the market's at an all-time high. I should not invest in the market because it's at an all-time high. It makes sense, right? It does make sense that you would not want to invest in the market if it's at an all-time high. But what this shows is 1 year from rolling market highs, S&P 500 from 1926 to 2022. 1 year from a new market high, which happens a lot, by the way, about 74% of the time. 1 year past market highs, the average return of the market is 13.7%. 5 year from a market high, the average return is 10.2. Those are pretty good returns. The S&P 500, which I'll show you here in a bit, has done about 10% since 1926. So you're talking about investing in highs is actually above the long-term historical average 1 year from that point. Which takes you to the next question of, well, why wouldn't I wait until the market pulls back 10%? Constantly we hear this. The market's at a high, we should wait, particularly when people are sitting on cash. When you have cash, and I tell people, go ahead and hold your cash because of the second definition of success. I hear, oh, it's somebody doing work upstairs. I was thinking, what am I hitting? Is the video still on? What's going on? So when you're sitting on cash, I'll tell people just hold it until you're ready, not because there's any evidence to suggest that's the right decision, but because our relationship is not just execution, it's confidence and comfort. And if you deploy the cash and then the market goes down, you're going to say, I knew it and I should have never put the cash in the first place, right? But this shows that actually you can see it's lower. Still a good return, but the return is actually lower when you wait 1 year later when you wait for a 10% decline than it is when you just invest at a market high. Again, I'm willing to acknowledge your personal bias plays a role in our relationship. I just can't acknowledge it through data that supports it, which is okay. You guys have all been such great savers that many of you can afford to not do things optimally all the time, and it's not going to have much impact on your lifestyle. That's not how we view things though, right? We want to try to be as efficient mathematically as we can all the time. So that's overvalue. The next one that we're hearing right now is the stock market hates the idea of rising interest rates. Again, you get back to that rationale that I talked about earlier. The idea is as bonds become more attractive, people are going to run out of stocks and they're going to put more money in bonds because they can make better yields. And that flow is going to cause flows of money into fixed income and out of the equity markets. In investment circles, the institutional money they call smart money. That's money that doesn't do that. I won't tell you what they call the rest of the money, but it's the opposite of the smart money. Institutional means this is what big institutions are doing. They're not doing that, but the consumers might. So what this graph shows, I'll let you just kind of take a quick look at it, is these dots, each dot represents the market return, and what's on this graph is the percentage of return of the market, and what's on this graph is the interest rate environment. Okay, what we're looking for here, and keep in mind, when we dig for data, we generally don't have a preconceived notion. I don't know. Certainly, am I sitting in my office saying, oh, I wonder if the market's going to go down because a bunch of people are going to run out of the market? Yeah, I'm human. I have that same thought. But then I look here, is there correlation? The answer is clear. There's no correlation. There's plenty of times where the market has been very good despite interest rates on fixed income assets being very good. So there's certainly no causation here that every time the market experiences high interest rates on the other side, that flows of money come out of the market and cause subpar performance. In fact, if you plotted a line, you might actually see that as interest rates go higher on a percentage basis, it looks like more often the returns are actually better than when you get over here kind of in the middle. So I don't think you can conclude that markets are going to suffer from high interest rates. This one is a similar style graph, a little harder to see. This one really defies kind of rationale and what you would think. And it's really just based on the fact that each one of these dots plots a market return at a progressive level of government debt. Getting back to the monetary policy discussion, we know that debt continues to increase. You definitely hear in the media that our debt levels are unsustainable. And we got to remember, I don't know if that's true from an economic perspective because I'm not an economist. But what I am sure of is there's no correlation to government debt causing problems in market returns. None. I mean, you look there, you cannot find a correlation as debt has gone up that we have more numbers on the bottom end of that return axis. In fact, if you look at some of the specifics, current US debt to GDP is 121%. There's been 153 times, I actually forget the data, the time frame, but I'll remember that, maybe the last 30 years, where the market has been, or where countries have gone over 104, or have gone over 100% debt to GDP. 104 out of the 153 times the market was up. And Italy and Belgium, as an example, they've been above 100% debt to GDP for over 30 of the last 48 years, and that's their market returns, respectively, 10.8 and 12%. Again, I'm not trying to tell you that the government debt isn't important, and we shouldn't be upset if we don't have balanced balance sheets and all those things that come into play, just as in terms of how we want our country to run and where we want our tax dollars to be spent or not spent. But relatively speaking to the market, there's no indication that as the U.S. continues to progress into higher levels of debt to GDP, that should cause you concern around capital markets. That leads into government stalls or government defaults, right, when the government shuts down. There's a bunch of them in here, but I'll just focus on these which we've plotted. So that one lasted for 5 days. This one lasted for 21, right? These are the various times of government default. This is what a dollar would have returned through the period of government shutdown. You can see that none of them are negative. So it also wouldn't be supported through data to say if the government shuts down, that's going to be bad for the market. It doesn't, this one, which was the longest down here, the latest one in 2018, 34 days, over 34 days, a dollar grew to $1.11 during the period while the government was shut down. That brings us to the concern about recessions. Right? We're concerned about interest rates. We're concerned about debt. We're concerned about valuations. We're concerned about recession. Right? This has not dominated a lot of the narrative recently. The government or the Fed is going to go too far. They're going to push us into a recession, and that's not going to be good for the markets. Well, this period, you guys know from some of the previous discussions that the common or conventional wisdom around a recession being 3 negative quarters of GDP is not valid. It's actually defined in hindsight by NIBR, which is 8 economists who tell us if we were in a recession. This was the period of recession from December 2007 to May 2009. Here, this is when the recession was announced. This is when the end of the recession was announced. What this graph shows is the time the recession was announced relative to the low in the market. And again, bless you, by the way, we want to be honest about, we're not here to pick data that supports something for us, right? we believe the data supports the way we invest over 100 years of evidence, and not everything fits. But in here, what you can see is the announcement of the retirement or the recession was June 1980. The market low was March, so they were 3 months behind the low. So by the time they announce if there's a recession, in this case, you can see that 4 out of 6 times the recession came after the market had already bottomed. And there were, outliers like 1982 where the bottom wasn't until 6 months after they announced. Right? So, one of the things that I think is true is there's always a yeah, but, right? No matter what we talk about, there's a yeah, but. The question is there an action you can take that increases your probability of a successful experience? That's the question we have to ask. Sure, do sometimes valuations represent stocks that are overpriced? Absolutely. Sometimes when interest rates are high, does that cause problems in the market? I'm sure. Is there enough indication that the probability is high enough that you should do something in reaction to that? That's where I think the answer stays consistent at no. In fact, over the recessions going back to 1926, the average return of the market is 8.8 through the recession. And then many of you have seen this, I've gone over this, but this is returns peak to trough during the last 11 recessions, average 0, so not particularly negative. The big thing is 1 year after a recession, you see returns of almost double market long-term averages. So what that indicates is if we do hit a recession, first of all, the announcement may be already too late, but what we definitely shouldn't do is we shouldn't reduce exposure to the market, because that's what generally comes after a recession. Okay? And then the last one in this section is the elections. I've done a deep dive on this 4 years ago. I'll probably do another one maybe in the third quarter of this year, because we all know that only 7% of what I say today is going to stick. And so you'll come back and you'll be, somebody in here is going to tell, who's sitting on cash tomorrow is going to say, I want to wait till the market pulls back. Somebody's going to say, I'm worried about the elections. I used to have people, it was kind of funny during that period, before the last election, I'd have people come in and literally I can remember one day where I had a Trump supporter and a Trump hater come in right behind each other. And the narrative was like, one's like, well, for sure if Trump gets elected, the market's going to crater. And then the other one comes in and says, for sure if Biden gets elected, the market's going to crater. And I was like, here, let me give you guys each other's phone number and you guys can answer. But there's no indication that there's any correlation to that. Okay? Why? And some of you have had more recent reviews, you've heard this, but this is what I alluded to earlier. This graph, the blue line is the trend of corporate profits. And this is the S&P 500. When that line's going up, it means on the whole, the companies in the S&P are getting more profitable. When the blue line's going down, the companies in the S&P are getting less profitable. And profit is synonymous with earnings. It's revenue minus expenses. So as I've mentioned to many of you, it's pretty logical, right? We go into 2022, what happened in the revenue and expenses kind of calculation? What was impacted the most? Expenses, right? Inflation goes up. Cost of capital goes up, that compresses profit margins. The market naturally corrects. But I mentioned it with Spotify and all the other, AI, innovation, right? The companies that you invest in, by and large, are run by the best business owners on the planet. The boards, the tacticians, the tax people, the legal people, right? The financial departments. You don't get to be that size of company by not running things well. And of course, there's corruption in there, I'm sure. There's bad business owners in there. Some of the companies who are good now probably won't even be around 10 years from now. But when you invest in an index or something similar like you heard on the video, where you're getting exposure, you're getting that volume of companies, we believe the companies will do what they're supposed to do to resume profitability, as difficult as those decisions are to make. Why? There's one reason why they will do it. Anybody know? It's their mandate. They have to. Their mandate is to generate profit for their shareholders. And the pressure to do that is incredibly high, right? And I was talking to Robert a while back about this, and it's one of the things that, getting back to that idea of you having confidence or comfort in your plan. Well, 15 years ago, we worried a lot. And I've said this to some of you again who've been in more recently, because this just started kind of coming into my brain. I worried all the time about the business and how the market related to the business. So much so that I bet you my kids could have told you by the way I walked in the door if the market was up or down that day, right? My patience level was directly correlated, right? Well, I woke up in the morning, the first thing I did was check the market. After I ate breakfast, I checked the market. Then I got to the office, I checked the market. When I got out of a meeting, I checked the market, right? And don't take this to mean that we dismiss this, but there are times I do check the market every morning, and I check the market before I leave in the afternoon. But there are some times where I don't look at the market at all in between that period of time. Relax, my traders are watching the market all the time, okay? But why? Because of this. Because I believe that over time, economic conditions, geopolitical, I mean, you think about the markets. I mean, we're talking about world wars, cold wars, oil crisis, bank crisis, pandemics, mortgage crisis. I mean, you name it, this has happened over and over again. And it's David Booth, who's the founder of the Booth, or the namesake of the Booth School of Business at the University of Chicago. He will write about this all the time, but it's really the confidence and the ingenuity of people that they'll figure it out. I just thought I'd show this because, okay, so what do we do, right? Where are we on time? All right, perfect. I got about 10 minutes, 12 minutes. I think I should be able to be there. I say this oftentimes before presentations that I don't want you to think that every time you drive here that I'm going to say something that blows your brain away. Right? There's not that many things. Believe me, I spend a lot of time anxious about, is what I'm going to say move the needle? Are they going to care about this, or are they going to, who's going to be nodding off? And by the way, I've seen a few of you. I try to keep it cold to avoid it. Right? Some of you may know, from no effort of mine, but an article I wrote years ago was used in Tony Robbins' book called The Master of the Game. And so because of that, a handful of us got to go be a part of his small group. It was 50 people. So much so that when he got up and started screaming, he told the person in front of him that he was going to charge him extra for the spit that was landing on him. But I learned from him, you got to keep rooms cold, otherwise people fall asleep on you. So these are just some of the things, what do we look to define the strategies that you guys participate in when you hire us? We look at these probabilities. None of them work all the time. None of them ensure success every day, but we're drawing on the best of academic research. And I think I'm going to try to get Weston Wellington to speak again next year. He's a PhD with Dimensional, and he would say that all PhDs in finance work for them. They just don't know it. And so basically the notion was every PhD student in the country is writing papers that they're tapping into and looking at. The gentleman who kind of laughed at the front, the balder guy, that's Eugene Fama. The guy right behind him was Ken French. Those are the two that built the Fama-French 4-factor model. But I've heard him speak, and that little giggle that he has, he does it all the time. I think mostly it's because our questions are so dumb to him that he can't help. And I've been around researchers. Last time I had a study group and they brought a researcher in, I was sitting next to a guy that I know is a CFA, and I was very pleased to know that he was as lost 15 minutes into the discussion as I was. I wasn't feeling so secure about that. So first of all, it starts with a belief that markets are efficient, and they're efficient because of the volume of pricing, right? Weston will say, if you think Home Depot's undervalued, right? First of all, how many eyes are on that stock, but you feel like it's undervalued, and so you buy it. Let's say it's at 100, and you think it should be 150. Well, you have to do that ahead of everybody else, right? Because if everybody else thought it was worth 150, then the price would be 150. So you have to find a way to do that ahead of everybody else. But if they don't agree with you and determine that, yes, it should be worth 150 and drive the price up to 150, that doesn't work either. So not only do you have to be right about it being undervalued, but you have to be right before everybody, and then everybody else has to eventually agree with you. Right? That's why it's so difficult to find mispriced stocks. That's why stock picking is such a low probability. We acknowledge that it'll happen every year. Somebody will do it really well. Some hedge fund knocks the cover off of it, right? That's it, that happens, and then they ride that performance for, you know, their subpar performance for the next 5 years, and it's all, you know, it's all anchored by the 1 year that they really, you know, smashed it. So $675 billion of trades every day. This is U.S. domiciled fund performance from 2003 to 2022. At the start of 2003, there were 2,855 funds. 44% of them are still around. You don't see bad performance from funds. Why? If I build a fund, what am I gonna, and it's not good, what am I gonna do? Leave it for you to keep Googling? I'm just gonna shut it down so you can't find it anymore. That's why so few are left, and 17% beat their benchmark. You guys have seen some of the data that the evidence that we follow, you know, historically has had somewhere closer to an 80% probability of outperforming the benchmark. But a lot of what drives that is market timing and speculation versus just trying to execute on high probabilities over time. Of that 25% that outperformed, 22% did it again the next year. So not only is it hard to do in 1 year, but it's even harder to do over consecutive periods of time. And why do that when the market has rewarded people who have just hung in with capital markets? A growth of $1 since 1926 in small companies, 26,000, large companies, 11,000. I told you that the market grows at roughly 10%. So if you're going to deviate from the market, I would argue it should be something that's got a high probability of a successful outcome. Or for financial planning reasons. Right? We have other things to consider, whether it be taxes, distributions, right? Different things that come into play when we're thinking about not just the investment component, but how investments fit into a broader wealth management strategy. Average return, as I've mentioned a handful of times, S&P 500, 10%. This band in here, right? That represents when it's within 2% of that 10%. You can see you don't get 10% very often. So you have to be resilient in going through these periods to get to that kind of average. Doesn't mean you should do nothing. It just means the basis, you know, I think linearly, and so I think of it as, well, what can I do to help people? Well, first, let's dispel the myths that cause the anxieties, that cause people to want to make emotional decisions about the market. Then let's continue to instill confidence in the market, both through the faith in human ingenuity and the actions of business owners, but also through how that's manifested historically. Because as I mentioned, this has taken us through depressions and world wars and all kinds of stuff that the market has continued to be resilient through. And it doesn't just happen on an annual basis. You have to be able to do this on a yearly basis. Some of you guys have seen things like this, but this is intra-year decline. This is end of the year return. So, you know, if you go back to 2003, at one point during the year, the market was down 13%. It finished up 31%. So it can't just be an annual thing. This happens consistently throughout the year, that you're having these, you know, significant variations and deviations in return. And if those coincide with negative narrative, then you have the, you know, the confirmation bias. Yep, I knew that this was bad, and look, the market is showing me that it's bad, which unfortunately causes a lot of bad decisions. I mentioned earlier the market's up 74% of the time. 73 years, I would expect it's going to have its 73rd, but this is the dispersion of returns in the market. It just gives you the idea that when people are sitting on cash and they want to know when to put the market in, or their money in, the market's up 75% of the time roughly. It's got to be now, because statistically every time you wait out of the market, you're missing the 75% probability that the market's going to be up. That doesn't mean that some of you, we should follow exactly the opposite of what you do, because every time you put money in, the market's going to go down. That does happen, right? But it means it's not statistically supported. Again, that brings us back to, it's not a good time to invest. Markets are hitting highs all the time. So if you don't want to invest at an all-time high, you're going to continue to sit on the sidelines and miss return, statistically. So I wanted to dig deeper into one more, a little more complicated topic. And this is more specific to, David Booth will say, you cannot outsmart the market, but you may be able to outperform it. And how do we do that? Through highly statistically probable decision making, right? There's a lot of it, right? We talk about not getting your distributions from things that are at risk. We don't want, if you need $20,000, we don't want to sell stocks at the wrong time to give you $20,000. We talk about banded trading sometimes, right? Where we have these thresholds where when things move up, we sell and take some profits. When things go down, we see them as being relatively discounted and buy more of them, right? These things all have statistical probabilities of success. The evidence from the University of Chicago starts with these concepts. You heard a little bit in the video that smaller companies beat larger companies over time, value beats growth, and profitable beats low profitable. But even in profitable, which is kind of surprising, in a 1 year period of time, 34% of the time, companies that are less profitable outperform the ones that are more profitable. It gets to that statistical probability of kind of setting the expectation that if you think it works all the time, you're going to be chasing your tail. That's not how it works. Those probabilities are all pretty good. Get back to the 17% of people who beat the market. That's a pretty good probability across the board when you look at these. Value stocks is one that's been in the news a lot, so I wanted to deep dive this a little bit. 60% of the time in 1 year, 79% of the time over 10 years. The idea also is if you do enough of these things that have high probabilities, some of them are working all the time, some of them aren't working all the time, right? You get back to value. This is March 2020 to March 2021. This is the monthly returns. Over here, you saw growth significantly outperforming early. That -19 means value underperformed growth by 19%. But then you see at the back of the year, it turned very quickly. So again, how am I going to assess economic conditions as a justifier for making some of these decisions? They're not switching that fast, but the market is, right? If you look at this 3-year period, value stocks underperformed growth from June 2017 to June 2020 by roughly 20%. Right after, to December 2022, or 2022, value outperformed growth by about 22%. So obviously, we deploy different strategies. You guys know that we do that. We have income strategies, which we call yield strategies. We have balance strategies, which are the things that have stocks, bonds, alternatives, kind of those things that are designed to minimize risk over time. And then we have growth strategies that are designed to be, more long-term and really try to maximize returns. All of those have different components associated with them. And we'd love for every time you came in if all of them were winning. But it wouldn't be a reasonable expectation to set, right? Because if we're deciding that value has underperformed growth, right? If we look at the numbers and value stocks have underperformed growth. By the way, I didn't mention this. Value means relative price. So it makes sense that you would have a higher expected return from value stocks, right? It's just like when you go shopping. I've used this example with some of you, but if you were going to go buy a car and it was worth $100,000 and then you decided that's too much, it's not priced right, and you left and you came back 6 months from now and it's at $90,000, well, first thing you'd want to do is make sure that it's not because there's some major defect. But once you ensured that it was the same car, you would just see that as a better price. So in 2008, when stocks came down, it was the whole market that came down. Stocks weren't losing their value necessarily because the individual stock was problematic. They were losing value because the systemic drop in all the markets. Well, that created a lower relative price, which is a better time to buy. But you're not, who knows when that better time to buy is going to manifest in a gain, because you could do it right here and 3 years later, value's still underperforming growth. Right? So there has to be that resilience and that patience to be an evidence-based investor. Fortunately, because we have different strategies, we're able to mitigate the risk of one thing working, and generally speaking, enough things work where we continue to have a successful experience. If you look at what's happened to your portfolios this year relative to benchmarks, you can see that things have worked, not because we predicted anything, because these probabilities manifest the way we expect them to over time. And in this case, value has outperformed growth by 4.4% since 1926. So how do you outperform the market? Well, you follow the evidence and hopefully you grab some of the 4% of outperformance over time. You guys, many of you have also seen that a couple percentage points makes a really big difference. So we don't need to outperform or provide value at 10% in a given year. If we get a quarter here, a half here, an eighth here, little bits over time for the type of money that you guys have saved, that adds up to big numbers. The last thing I'm going to finish with is, I didn't even say, that's the funniest thing I said the whole time, and I didn't even say anything. You guys have all seen this, right? I mean, just about everybody's seen this in our office at some point, but this is called the periodic table of investments. Each color represents a different asset class. So small stocks, large stocks, government bonds, corporate bonds, whatever it is. You know, at quick glance, you can just tell right off the bat, nothing stays on top for too long. So getting back to that, you know, valuations question up front, what can you do? Well, don't run from those companies that have strong valuations because they've done really well. And, you know, many of us think the innovation of those companies, a lot of them are going to continue to do really well. But you need to diversify yourself away from concentration in those so that you can look a little bit more like this white line or these white boxes than going from this down to this, up to this, down to this, right? And there's a place for that. We accept that greater level of volatility in our growth quadrant. In the balance quadrant, this is what we're striving for, which sometimes can be a little ho-hum because you're never doing really well, but you also shouldn't be doing really bad either, right? And there's need for that too, which is why we strategically allocate to different strategies over time. This just shows that those portfolios that had things that moved in opposite directions. So since 2000, U.S. markets returned 6.8, foreign markets 4, and a diversified portfolio did 7.5 because you're not going down all at the same time and up all at the same time. So there's 3 things that I figured I'd leave you with. And then I do have a couple bullet points that I want to touch on before I let you go, just some company updates. It really boils down to, first and foremost, manage your emotions. I think the best way that you do that is by looking beyond these headlines and then getting back to focusing on the things that you guys can control. Nothing mind-blowing, but hopefully, you know, getting back to that definition of success, you guys can continue to have confidence in us, that evidence that we follow, those academic elements of research, that discipline, that non-emotional approach that we take is the reason you hired us in the first place. I know when we spot checked people in 2020, we didn't call everybody, but we called a few people just to kind of get an idea how people are doing. A good majority of people said, I hired you because you guys don't do things emotionally, and that's a big attraction for me. And so we obviously want you to continue to do that. And then hopefully, as you continue to see us over time, you bring these concerns, we continue to address the narratives that are causing you worry, that you can find out if the worry is justified. And by the way, we do the same thing. When I find something that I'm concerned about, the difference is we have immediate resources that we trust. And we can, get to that information quickly. And frankly, the academics, they do a great job of holding that pulse too. They know what you're worried about, which is why when I'm worried about something, oftentimes I'll go to a couple of the companies that we work with and they've already put together data around it. And I'm like, oh, perfect. They knew exactly what I was worried about yesterday. Okay? So a couple things. We're expecting to move next year at some point. We're moving, we've signed leases, so that generally means it's going to happen, but we're moving to one of the buildings that's in our parking lot. So same set. There's 3 buildings that are identical. They're beautiful from the outside if you haven't seen them. I'm just kidding. Not they're a little funky from the outside, but they're nice on the inside. We love that area. It's easy to get to. It's plenty of parking. It's slow pace, so we're going to stay in that area, and ideally that'll happen sometime, by the middle of the year. So we'll have, likely have an open house, and but if you found the old office, I'm sure somebody will call me and say I'm up at Suite 585, and we'll say we're across the way, but that'll be there. Schwab, I'm in Schwab's building, so I have to be very quiet. But Schwab merged with TD Ameritrade, so just be aware. They're dealing with a lot. They're aware. They're doing as much as they can. I don't think they're dropping the ball, but there's just a lot of volume that they're dealing with. So if you have requests, try to make sure you give us ample time, because obviously we're somewhat beholden to them as well. But they're doing a wonderful job of everything they do, by the way. The newsletter, we're going to have, we want to try to simplify communication so it's not coming out in different things. Newsletter, market review comes out, and then invitations come out, and they come out in different places. Lots of times we hear I'm not getting the emails. Of course, first thing I do is I go to Amy and say, something's wrong, they're not getting the email, and then she pulls up the thing and says, yes, they did get the email, they actually opened it. But, and so, just be advised that in 2024, we're going to try to send out a newsletter that's going to have those things consolidated in one place. So messages about office closures and upcoming events and all that stuff. So, we're going to try to make that a little bit easier on you. And then 2 last things. I don't know who in the room has or hasn't offhand, but 2023 was really a phenomenal year of referrals. So I just want to extend thanks to those of you who've been willing to introduce us to people. We do feel blessed, the quality of people we get to work with every day. I think sometimes about Amy's husband, who's an Arapahoe County Sheriff, and think about who he has to deal with all day long versus who I get to deal with all day long. And so we're definitely, incredibly thankful. We obviously always want you to know that we'll honor the sensitivity of those relationships and make sure, as we were with you guys, hopefully that you won't feel pressure or they won't feel pressure. Also, we have reserved 1 table at every one of our dinner events if you want to come and bring somebody. So those will be in the newsletters, generally at Shanahan's, but you guys can, if there is somebody that you want to introduce, you get to have a meal. The only thing I ask is that you laugh at my opening joke, even though you may have heard it multiple times. And we're also going to have some events next year, a friends and family event, where we're going to try to have a special event for those people who are willing to do that, just to acknowledge our thanks. The SEC proposed a few things that were an obstacle to that over the past couple years, but looks like we're in the clear, so we'll go ahead and do those. Last thing is just, it's a great time of year to, to see everybody. We won't get the chance to see everybody, but we want to, wish you guys a happy holidays, whatever it is that you celebrate. Hopefully you guys get a chance to be with family and kind of tap into what the season's all about. And we're here, so a bunch of us will be sticking around. If you guys need anything, please let us know. And otherwise, you guys have a great rest of your year, and we'll get out the dates for the first quarter Food for Thought as soon as we can. Thank you, guys.